Well, I think it's when you look at it from the mainstream perspective, yes, much of what they said was valid. It had gone up, really unencumbered for 9 straight weeks. It was overbought. All of that's valid. All of that's true. It had busted through well in excess of moving averages, the 50, the 200. All that's true. It was ripe for a correction and a flush and a pullback, and all of that is true. And if it had been said that way, of course, they always throw in, is this the top, the 2011, 1980 top, where it starts to head down and maybe, this is it. Maybe look for other assets, Bitcoin, or whatever the hell you want to talk about it. If they would have just told the other half of the story, I would have been more inclined to acquiesce to some of their validation or to some of the things that are valid. I think by not telling the whole story, it invalidates much of what they say. The initial snowball that was pushed down the hill was in the middle of the evening after all of the markets had closed and the New York traders were in bed, and it was sold in the access market, it being gold and silver, billions of dollars worth, in the middle of the evening when there's no liquidity, when the markets aren't there to catch the bids, and instead the driving down of the price, dumping it onto the market at strange hours. When it started, it was in the middle of the night. I don't remember exactly what time. And then the next day they did it at like 8 or 9 o'clock at night, when in between New York and Asia. Again, New York's closed, Asia hadn't opened yet. You see a price that's getting clobbered because all that does is hit the sell stops that are embedded in algorithmic programs along the way, and they drive the price down. In other words, this was done as a drive-by shooting for an effect. There would not be a trader on the planet with a third of a brain cell that would dump all of this at a time outside of New York trading, where that's where the price is set. That's where the bids would be. They would do it slowly and judiciously over time, even a matter of days, that amount slowly, without alerting or waking everyone up to a dumping of metal. And they would catch all of the demand for 9 straight weeks that have been growing up. They would have got a much better settlement. In fact, they guaranteed themselves the absolute worst settlement. And so the selling, triggering stops, made the market collapse. Now, what they also didn't talk about, and let's just stop right there for a moment. If they would have said all of those things, market's overbought, gone up for 9 straight weeks, the technicals said this is ripe for a correction, for a flush, for a pullback, whatever validation they want to attach to it, it's invalidated by not saying, by the way, some idiot dumped it in the middle of the night when there was no liquidity in the market and there were no traders, and this is done in the access market. Nobody would do that. They conveniently leave that part out. The other part that they left out was the second day, when it was done in between New York and Asia. Again, equally a stupid time to do it. Within just a few minutes, the silver price shot right back up. Well, how the hell did that happen? Well, if you look at Michael Lynch, and he does an amazing job at analyzing the COMEX movements. He says that it was Bank of America and Morgan Stanley that came in and did the purchasing. It was European banks that did the selling, and it's commercial banks, and it was Morgan Stanley that came in and did the buying. Well, why is that valid? Well, the chief investment officer of Morgan Stanley recently came out and said the 60-40 rule of investing that Wall Street's used for, 50 plus years was invalidated now by
60-20-20.
Yes. In other words, sell half your bonds and put 20% into gold. And then that's Morgan Stanley. And then Michael Hartnett, the chief head analyst for Bank of America, says no, 25, 25, 25. 25 stock, 25 bond, 25 short-term treasuries, 25 gold. And I mean, in my whole career, I've been 35 years, they've never said that at all, ever. Yeah. Maybe 5% they would say. So the two American banks that are saying 20 to 25% allocation come in and do the buying, according to Michael Lynch. And he's got a great Substack. People should check it out. So when we talk about this, the fundamentals are fugazi. The fundamentals are strong as hell. The LBMA is being bled down. I did an interview with Alistair McLeod this morning, and Alistair's like, yeah, I see this morning that the slight backwardation is reappearing between London and the U.S. again. So all the metal that got shipped from Shanghai at exorbitant lease rates, and whatever 20 or 30 million ounces that got shipped from Comex over there to quell the problem. Well, what good did that do? There's still deliveries next month and the month after and the month after. And so the physical demand is overwhelming the paper price, and it's desperation when you come in the middle of the night and dump at a time that no one would do it. It was specifically done to cover shorts and for effect, and for the media to jump on and tell half the story without saying, by the way, some idiot dumped it when no one else ever would, to maximize the worst possible settlement they could ever get. And so that to me invalidates so much of what would otherwise be valid statements. And I think it goes to show where silver is ultimately going. The U.S. government has proposed and written into draft, and it will be accepted, that silver will become a critical mineral in this country. Things are changing, and I think what we saw was a desperate attempt by some really caught commercial banks that are massively short, and the rising price, coupled with a government shutdown and trade meetings with Xi and all sorts of stuff going on. The last thing, and interest rates going to be lowered again. The last thing they wanted is for metal to get way out of control, and this is their way to stop it, but I would argue only temporarily. The exploitation of the delivery option in London and the US is something that was rarely exploited, and now it's being exploited not only by all of the BRICS nations and Russia, China, India, Saudi Arabia, and all of the countries that are standing for delivery on all of the world's commodities, but there's someone got to President Trump, in my opinion, and said, if we don't do this, we're dead. We're dead, because they're draining the shelves across the globe. And so they phrase it as tariffs, and they start bringing it back. It's not tariffs, it's reshoring. All the gold and silver, billions and billions and billions and billions and billions of dollars worth of metal. So far this month, which is a non-delivery month in silver, just shy of 8,000 contracts have stood for delivery already, at 5,000 ounces apiece. So do the math. I mean, it's not a delivery month, but it's still an awful lot of silver.
When you look at the recent sell-offs in gold and silver, the mainstream explanation sounds neat and tidy. Markets were overbought, they said. 9 straight weeks of gains, well above the 50 and 200-day moving averages. It was time for a correction. And you know what? That's not wrong. Gold and silver were extended, momentum was hot, technicals were ripe for a pullback, and traders were due for a flush. All of that is valid, but it's not the whole story. Because if you actually watched how it happened, you'd know this wasn't some natural market correction. This was engineered. It was a drive-by shooting in the middle of the night. Let's walk through it. The first sell-off came after New York markets had closed. The US traders were asleep. London was closed. Asia hadn't opened. And right in that thin, illiquid gap, billions of dollars worth of gold and silver contracts were dumped into the futures market. That's not how you sell if you want a good fill. That's how you sell if your goal is to smash the price. Anyone who's ever traded knows that no rational trader would unload that kind of size into a ghost market. You do it during liquid hours, when there are buyers on the other side, when bids are thick enough to absorb your size without killing the price. But no, this was done precisely because there was no liquidity. It was time to trigger stop-loss orders in algorithmic programs. You hit the market with a wall of paper, you blow through the bids, and you cascade the stops. The chart collapses, headlines scream, and everyone thinks the rally is over. And then what happens? The next morning you see big buying come in. Morgan Stanley, Bank of America, scooping up the metal that got dumped at fire sale prices. You tell me, is that coincidence? Michael Lynch, who's done some of the best forensic work on COMEX movements, broke this down beautifully. He showed that the selling came from European banks, massive commercial shorts who have been underwater for months, and the buyers were American commercial banks led by Morgan Stanley. And that's significant because Morgan Stanley's own chief investment officer has already gone public saying that the traditional 60-40 portfolio model, 60% stocks, 40% bonds, is dead. Their new model, 60-20-20. Sell half your bonds and put 20% into gold. Read that again. A Wall Street titan telling its clients to allocate 1/5 of their portfolios to gold. In my 35 years in this business, I have never seen that. Not once. The biggest banks in America are now recommending gold allocations that were once considered lunatic fringe. And then you've got Bank of America's Michael Hartnett, another heavy hitter, saying the same thing. 25% stocks, 25% bonds, 25% short-term treasuries, and 25% gold. When two of the largest American financial institutions are telling their clients to buy gold in double-digit allocations, that's not noise. That's a regime change. So let's be clear, this sell-off was not a natural correction. It was a desperate maneuver by over-leveraged commercial shorts, trying to cover positions, trigger technicals, and create the illusion of weakness before they themselves step in to buy. And the media, as usual, played along. They ran the usual headlines. Is this the top? Is gold finished? Without mentioning that the dump happened in the middle of the night, outside any rational trading window. They tell half the story and call it journalism, but the other half of the story tells you everything, because the fundamentals for gold and silver have never been stronger. The LBMA inventories are being drained. COMEX is bleeding physical metal. Backwardation, the condition where near-term prices trade higher than futures, is reappearing between London and New York. That's a signal of tight physical supply. And even with all this manipulation, the price refuses to collapse. Alasdair MacLeod pointed this out recently. The backwardation gap that disappeared earlier this year is back. Metal that was shipped from London to Shanghai at insane lease rates, 20, 30 million ounces of silver, barely made a dent. It plugged a hole, not the dam. Deliveries are still piling up month after month. The physical drain continues. We're watching the largest eastward transfer of metal in modern history. China, Russia, India, the BRICS nations, they're standing for delivery on everything. Gold, silver, platinum, oil, copper. They're not trading paper anymore. They're taking the real stuff.
We need to do something quickly. You mentioned 38 trillion in debt and a trillion in interest payments, which is the number one line item. We added a trillion to the debt in 71 days recently. It's accelerating.
Crazy.
Our fiscal irresponsibility is ridiculous. 60% of America can't read past the sixth grade. 60% of America has no college education. Most people in the country can't write out a check for $5,000 for an emergency. We're
Wow.
broke, we're insolvent, and the 38 trillion doesn't take into account the over 100 trillion in unfunded, 150 trillion in unfunded liabilities, Medicare and Medicaid, and Social Security and government military pensions. And I don't know, there's divisiveness in politics. There's, after the last 4 years of policy that was too stupid to be stupid, we've now entered a period of time where I think it's all about, an acceleration in a new system that's coming. So I'm concerned that we have hard times ahead of us. And I think what President Trump is trying to do, if there's any nobility in it, is to debase the dollar, to devalue it, to ultimately bring back manufacturing and to relinquish, according to Triffin's dilemma, relinquish the reserve standard. If we are the reserve currency, we will never have a manufacturing base. We will always run trade imbalances. I believe they want to get rid of the world reserve currency. They want to bring back manufacturing. And if Judy is right, and they peg gold to the back end of the treasury market next July, you can bring back with a 20, 30, and 50-year treasury redeemable in gold with zero coupon, no interest in 20 or 30 and 50 years. You can bring back manufacturing immediately with no upfront borrowing costs. And with the passage of the Stablecoin Act, the Genius Act, you look into it and you see that every time money moves, stablecoins will be created. And the interest, because they're backed by U.S. treasuries, the interest that is generated is not transferable. Tether, as an example, USA Tether, by the way, their CEO is Bo Hines, the guy that was Trump's crypto advisor until August. He's not the CEO of USA Tether, which is already Genius Act compliant. They will back everything with treasuries, which creates synthetic demand for the treasury, pushes rates down, but they will take the excess, the interest between the stable coin and the treasury, and they'll buy gold. And I think they'll buy Bitcoin, and they'll buy gold to make it go much higher. They already have over $8 billion worth. They were just at the Beaver Creek Mining Summit. They're going to continue to buy gold to devalue the dollar and to ultimately peg the back end of the treasury market to bring back manufacturing, because we need to. Our children and our grandchildren are dead otherwise with illiteracy and uneducated masses and a massive spread between the haves and the have-nots and no manufacturing base and massively indebted. We need to do this no matter what. And I think they will do that through devaluing the dollar, massively by letting gold go higher. I think they'll let Bitcoin go higher and use it to pay off the debt. This isn't conspiracy. Read the order that next year they're talking about revaluing gold as part of the Bitcoin fund that Senator Lummis from Wyoming has been advocating for. And if they do revalue it, it devalues the dollar. It's not about revaluing gold; it's about devaluing the dollar to a much lower level, so we can sell our products to the world. You have to bring back manufacturing. How do you do that? You peg gold to the back end of the bond market, and you end up having zero upfront borrowing costs. There's like in the Shawshank Redemption, there's 2 miles of shit that we have to crawl through to get to the other side, like Andy Dufresne did. And that's what happens with the irresponsible fiscal policy that we've had and the brain dead monetary policy we've had for all these years.
Let's pick up right there, because this is where the real story begins. The panic selling in the paper market wasn't about price discovery, it was about survival. The commercial banks that are short gold and silver are bleeding, and they know it. This isn't 2013 anymore. Back then, they could dump paper metal and buy it back later because no one wanted physical. But that world is gone. Every time they try to knock the price down, physical buyers step in immediately. The East absorbs it, the US absorbs it, sovereigns absorb it. The metal doesn't come back. That's the difference between then and now. In 2013, you could sell paper and suppress sentiment. In 2025, when you sell paper, you lose inventory. The LBMA and COMEX have become the world's most expensive short-term leasing facilities. They're bleeding ounces faster than they can replace them. And here's the part no one in mainstream finance wants to say out loud. The physical market is starting to dictate the paper market, not the other way around. When you see Morgan Stanley and Bank of America stepping in to buy physical at these levels, you have to ask yourself, why now? Why not wait for a bigger correction if you think this is overbought? Because they know something. They see what's happening beneath the surface. You can read the same reports they can. Central banks bought over 1,000 tons of gold last year, the highest level since 1967. Silver demand hit record highs for solar, industrial, and investment uses. The U.S. Mint and Perth Mint are both rationing output, and inventories in the LBMA's eligible category, the metal actually available for delivery, are down over 70% from 5 years ago. That's not a correction. That's a depletion. Now think about how desperate a move it is to dump paper metal when you know the physical is vanishing. It's like throwing water on a grease fire. It looks like you're doing something, but you're actually making it worse. And yet that's exactly what these European commercial banks did. They dumped metal into an illiquid night market, triggered stop orders, caused panic, and then watched American banks buy the bottom. That tells me this wasn't coordination. It was capitulation. The shorts are turning on each other. Meanwhile, back in the real world, the fundamentals couldn't be stronger. The U.S. government is officially recognizing silver as a critical mineral. The BRICS are accumulating gold at record pace. And backwardation between London and New York is back, which means physical demand is overwhelming paper supply. Even Alasdair MacLeod, one of the most cautious analysts in the space, said it bluntly this week. The metal drain from Western vaults is unsustainable. And he's right. Once confidence in paper convertibility is lost, it's game over. The COMEX can't cash settle forever. The moment enough big players demand physical and the vaults can't deliver, the illusion breaks. I think we're closer to that moment than anyone realizes, because the truth is, this isn't just a metal story. It's a currency story. It's a global trust story. The world is watching the US weaponize the dollar, inflate its debt, and erode its credibility. They're responding by hoarding what they can't print. Look at the BRICS bloc. They're not just buying gold, they're standing for delivery on every commodity they touch. Russia, China, India, Saudi Arabia, they're all quietly shifting trade settlement away from dollars, and the West can't stop it. The only way for the US to fight back is to do what Trump's team is already hinting at. Reshore production, rebuild reserves, and re-anchor credibility with real assets. Call it tariffs, call it trade policy, call it what you want, but it's really a metal resettlement program. And the irony is, the sell-offs we just saw might have accelerated that process. When the paper price collapses artificially, it gives physical buyers the deal of the decade. The metal leaves the vaults faster, and once it's gone east, it's gone for good. That's the Achilles heel of this system. You can rig prices, but you can't print metal. Now let's talk about the implications for the months ahead. We're entering the phase of the cycle where the disconnect between paper and physical becomes undeniable. You're going to see premiums spike, delivery delays grow, and spreads between New York and London widen. Backwardation will deepen, and as that happens, the credibility of the paper markets will crumble. It's already starting. Silver has quietly become the most strategically important metal in the world. The US government's critical mineral classification isn't symbolic. It's an admission of dependence. Silver isn't just for coins anymore. It's for solar panels, EV batteries, weapon systems, and electronics. It's a national security metal. And when you have something that vital, something irreplaceable, you can't let foreign vaults or paper speculators control its price. That's why I believe you're going to see physical silver stockpiling by the US government again, just like during World War II. This isn't a conspiracy. It's history repeating. The difference is, this time, the public is watching in real time. Look at the data. Just this month, in what's supposed to be a quiet, non-delivery month, nearly 8,000 silver contracts stood for delivery. That's 40 million ounces. That's not retail stackers buying coins. That's industrial and sovereign scale accumulation. Someone, somewhere, is front-running a policy shift. Maybe it's China. Maybe it's the US quietly building buffers before declaring silver strategic. Maybe it's hedge funds that see the writing on the wall. But whoever it is, they're taking delivery because they don't trust the promise of cash settlement anymore. So what does this all mean? It means the bull market in metals isn't just alive, it's structural. The paper market is fighting for survival while the physical market quietly reprices reality. And that's why I laugh when the mainstream anchors say, maybe it's time to rotate out of metals into Bitcoin. I'm not anti-Bitcoin, but that's not what this is about. This isn't a rotation, it's a reset. The world is moving from a system backed by confidence to a system backed by collateral, and that collateral is gold and silver. We are watching the birth of a new financial order. You can feel it in the behavior of central banks, in the desperation of the commercial shorts, and in the quiet accumulation by institutions that once mocked these assets. That's why when you see a midnight sell-off, don't panic. Smile. Because someone just gave you a discount on the most undervalued monetary assets on Earth. The fundamentals have never been stronger, the structure has never been tighter, and the narrative has never been clearer. They can sell paper, they can trigger stops, they can scare the tourists, but they can't stop the tide. The metals are leaving the shelves, the vaults are emptying, the system is cracking, and when the final repricing comes, when the physical world reclaims control from the paper world, it won't happen gradually. It'll happen all at once. That's how every paradigm shift unfolds, slowly then suddenly.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.